Hi, welcome to this tutorial. In this video, we are going to take the trial balance and the adjustment, and we will prepare the final account and we will make the adjustment in the final account. We will use the learnings, the information that we had in the last two videos as well. So on the slide, I have the same trial balance as you've seen earlier. All I'm going to do is to decide where each of these items are going to go and then post them to their respective places. And I have the format for profit and loss account and the balance sheet with me. I'm going to pick each of the item and place it in one of the two places. And as we already know from the trial balance, these accounts have already been adjusted, the double entry effects have taken place, therefore these balances are going to go to only one place. That is step 1. Step 2, which is parallel, is adjusting for the additional information. Again, we've already discussed why these transactions will affect profit and loss account and balance sheet and how. We've already done that. All we're going to do is combine everything, the trial balance and the additional information, and we're going to write the balance sheet and the profit and loss account. So let us get started. Stock at the beginning of the year. This is the opening stock, and the opening stock is going to go to income statement. So in the profit and loss account, because we are using the account format. So profit and loss account on the debit side, and this is going to be shown in the trading account, the first half of the profit and loss account. So why don't I just go ahead and write it there? So I'm going to write opening stock. And one new thing that I've started doing in this profit and loss account is to write to here. Now previously we've not written to and by in the profit and loss account, but in some textbooks you will see that to and by are being used. The reason stays the same. This is an account. Any account follows the ledger format. So you have to and by used in the ledger. So that's why they use it. Even if you don't use it, does not matter. The idea for you is to understand how the data in the income statement is going to be arrived at. And this is the process. So do not worry too much about the prefixes to these. So opening stock, the amount is 60,500. 60,500. I've written it here. So I'm done with the first item, posted in the relevant place. The second item is purchase and sale. We have both the balances given in one row. So there is 90,300 and 137,200. Which one is for purchase and which one is for sale? Well, if you've been paying attention, purchase purchase always has a debit balance. So this is the amount of purchase, and sale, being an income, always has the opposite, the credit balance. So this is the amount of sale. Again, this is going to go to P&L account, and this is going to go to both debit and credit side in the trading account. Therefore, I'm going to write purchases 90,300 here to purchase 90,300, and I'm going to write buy sales 137,200. And I've written these amounts not in the amount column, because I know there are returns as well, and we need to make an adjustment. So this is done, and then you have returns. Returns again, you have amount in both the columns, debit and credit. And returns refer to purchase returns or sales returns. And we also know that the returns have an opposite balance, have the opposite balance of their parent account. The parent account, I mean purchase returns, parent account is purchase account, and sale returns, parent account is sale account. So if sale has credit balance, then sale return has debit balance. Purchase has debit balance, so purchase return will have a credit balance. Therefore, these are the amounts of purchase return and sale return. Again, they are going to go to debit and credit of the trading account. Now let me make that adjustment. This is the purchase return 1300. So purchase return is going to be adjusted here, and the sale return is 2200. So 2200 to be adjusted here. And let me write some detail here. Less the returns, less the returns. There you go, and you have 89,000 as the purchase, and you have 135,000 as the sale. Okay, and let's go forward. You have capital. Capital goes to balance sheet, and we write it on the liability side, 30,000. So I'll go to balance sheet here, and the first heading is equity. Under equity, we have shareholders capital. The amount was 30,000, I guess, and done. So 30,000, this is also done. Next up, you have land and building, 30,000, and land and building goes to balance sheet on the asset side under the non-current assets, land and building. So balance sheet, and we have non-current assets, and land and building. The amount was 30,000. Again, we know that there is depreciation, so I'm going to write the amount inside the column, and I will say less the depreciation. There is an adjustment. I'll just leave it at that. Whenever we reach at the depreciation, we will make the adjustment. Next up, you have furniture, and furniture has the same treatment. You go to asset side, and you have non-current asset, 8,000. So I'll go to balance sheet again, and I will write furniture. Amount is 8,000. We have to provide for depreciation, so we'll write less depreciation here. And whenever we reach at the adjustment, we'll pick up the amount from there. Next up, you have debtors and creditors. Again, both the things go to balance sheet. Debtors go to current assets, and creditors go to current liabilities. Amount for debtors is 25,000. So in the balance sheet, let me create maybe somewhere here current assets and debtors, 25,000. I also know that I have to provide for bad debts at the rate 5%, but I'll do that when I reach the transaction. So right now I've written debtors, I have posted debtor, I have to also post the creditors. So let me write current liabilities here and write creditors. The amount is 45,000 and done. Next is cash in hand, 8,000. So cash in hand goes to balance sheet under the current assets, 8,000. So let me write cash and 8,000. No adjustment required for the cash account. Then you have investment, 10,000, goes to balance sheet under the non-current assets, and there is no depreciation on investment at all. So 10,000 investment. There. Next up, you have interest. This is credit, so this is an income. So profit and loss account is involved, and you will write it on the credit side in the profit and loss account, not the trading account. This is other income. This is non-operating income. Interest, 500. So somewhere here is where I'm going to write the interest. Interest income, 500. I'm again writing it inside because I know there is more, there's an adjustment which needs to be made to this. Next is commission, 3,000. Again, credit balance. So this is an income on the credit side in the P&L account. Commission, commission income here 3000, and I know there is an adjustment which needs to be made. Then you have direct expenses 7500. The item clearly, the account balance clearly says direct expenses. So this goes to profit and loss account on the debit side and in the first section. In the trading account, because we show all the direct expenses. Direct expenses refer to the manufacturing, the factory related expenses. These expenses contribute directly to the cost of the goods. So 7500 is going to be shown here to direct expenses 7500, and I better use by here for consistency. Then you have postage and stationery debit side, clearly an expense, profit and loss debit side, and you show this in the profit and loss account. Again, one could argue that post and station could be used in factory. If you know that, you show it in the direct expenses. But in this case, we clearly have been given the direct expenses. So postage and stationery 2500. I'm going to write this on the debit side to postage and stationery 2500. Next is fire insurance premium 2000 debit balance. So this is an expense on the debit side, and we're going to show this in the P&L account. 2000 fire insurance premium. So fire insurance premium 2000, and I know there is an adjustment, therefore I'm not writing the amount in the final column. Then you have salary 11,000. Clearly it will go to debit side as an expense, and in the second half 11,000 to salary 11,000. Again, I know there is an adjustment, so I'm not writing the amount in the final column. Then you have bank overdraft 40,000. This goes to balance sheet on the liabilities side, and this goes to current liabilities. Bank overdraft is a short-term liability from the bank, 40,000, and in the balance sheet. So bank overdraft, the amount is 40,000. There you go. So we are done with the first step in the process of preparing the final accounts. We have posted the account balances from the trial balance, and every balance has gone into one of the two places, either profit and loss account or the balance sheet. So the first part, which we've already done practiced before as well, that has been completed. The only difference is that we know that there are some transactions where adjustment is required. Therefore, we have written some amounts, not in the final amount column. So that is something new. And the other new thing that we did was we are using to and by in the profit and loss account, just to familiarize you with this, because when you look at the textbooks or some other resources, you may see use of these words. The justification for this is there's a debit side, credit side, this is an account. So you better use to and by. Does not matter if you don't do this either. The understanding you should certainly have. Alright, the next thing to do is to adjust for the additional information. Again, we have gone through the additional information and we've identified the impact. So I'm not going to explain why I am doing certain treatment to these accounts. Why am I adjusting it at different places? But I'm just going to post these transactions in the respective places. Okay, let's start with closing stock. Closing stock, as we discussed, needs to be adjusted in the trading account. So this will go to trading account on the credit side, and this will go to the balance sheet under the current assets. So 65,000 to be shown here. I will write closing stock 65,000. Now by showing closing stock on the credit side, we are reducing the total on the other side. So that's the idea, and the convention dictates we show it here. Closing stock will also be shown under current assets. So closing stock 65,000, and we are done with adjusting the first first transaction. The second is an additional interest on investment 500 yet to be received. This was income earned but not received, accrued income. We are going to show this on the credit side of profit and loss account, credit, and we are going to show this in the balance sheet under the current assets. So 500 to be received is going to be added here. So we are going to add to it and we will call it accrued interest. Interest which has been earned, which has become due but we have not received it. Therefore, the total interest income in this financial year is 1000. The trial balance would have only given you 500, this figure, but there is additional 100. Now, since you have to receive this amount in next 1 year, this becomes a current asset for you as well. So we will show another current asset and we'll call it accrued interest. Accrued interest or interest to be earned but not received, 500 as a current asset. Next, you have commission received yet to be earned. This is advance income. We discussed that in the profit and loss account. You will deduct this on the debit side. You will take it out from the commission to be earned on the credit side, by the way, not debit, on the credit side. And in the balance sheet, you are going to show this under the current liabilities because this is unearned income. So 1000 commission we have to deduct. This is advance income. Advance income means that you have to still perform your services to earn this income. If you have not earned this 1000, you can't show this 1000 as your income as per the matching principle, and hence deducting this from the commission. And you have received this 1000, you have not earned it, you have to provide services for this. This is a current liability for you. So 1000 is advance, let me write, advance income or advance commission. There you go. The next item is 500 insurance premium paid is in respect of the next year's first quarter. So we have a prepaid insurance, prepaid expense in the profit and loss account. We are going to show this on the debit side and let's go there. So fire insurance premium 500 that you have paid out of this 2000. This 500 is for the next year. This is not this year's expense. So this year's expense is only 1500. So we are deducting the prepaid insurance. And whatever is prepaid, paid in advance, you have claim over it, you will convert this into a service. This becomes your current asset. So you're going to write prepaid insurance equal to 500. This becomes a current asset. So we'll show this in balance sheet under current assets. Next up, you have additional salaries worth 1000 are unpaid. Let me take these one by one. So salaries which are unpaid are going to be shown in the profit and loss account on the debit side. So right now the salary is 11,000 and we have to add to it the outstanding salary, unpaid salary which has become due, which is 1000. So the actual expense of this financial year is 12,000. The trial balances only give you 11,000. They did not consider the 1,000 which has not been paid. So 12,000 is the actual expense. The 1,000 which has not been paid will be paid within next 1 year. It becomes a current liability. So you will write it under current liabilities in the balance sheet. So outstanding salary, this is 1,000. The other part of this transaction was interest on bank overdraft is also due. So we will show this in profit and loss account on the debit side and in the balance sheet under the current liabilities, same as we did for the outstanding salaries. So here we are going to show two interest, I should say outstanding interest rather. So let me just correct it to outstanding interest. Now, interest on overdraft, you could write the detail as well. The amount is 2000, and this outstanding interest also goes to balance sheet under the current liabilities. So one point here is that you do not have an existing expense like salary where you had the 11,000 already paid. You added to it 1,000. In this case, there is no existing amount. You're just showing 2,000 which has not been paid. So all the salaries, if they were not paid, you will show directly in the amount column. So likewise. So it doesn't matter whether you have already spent it or not. If something is outstanding, that means this amount is to be considered as the expense of this year. So we show it as an expense 2000, and this has not been paid, become the current liability, and hence show it in the balance sheet as well. Then you have bad debts, 5% of sundry debtors. This is a loss, so we will go to profit and loss account. On the debit side, we'll show this as a loss. So I'm going to write here 2 bad debts, and this is 5% of 25,000, which was the debtors amount. So the amount is going to be 1, 2, 5 and 0. And here 1250 to be deducted, so you have net amount of 23,750 as the balance in the debtors. So this goes to balance sheet under the current asset to be deducted from the balance of the debtors. The last adjustment is depreciation. Depreciation is regarded as an expense, so we will show this in the profit and loss account as the debit on the debit side. So I write 2 depreciation. Now depreciation is to be charged on two accounts, land and building 5% and furniture 10%. And let me go to balance sheet here. Land and building 5% comes out to be 1,500. So here the balance is going to be 28,500. And for furniture we have 10% depreciation, so 800. The balance is 7,200. So these 1,500 and 800 will be shown as expense. So 1,500 and 800. So depreciation on land and building, and 2 depreciation on furniture. Again, in the final income statement that you see, you club all the depreciation expenses and show the final number. In the notes, you can provide details of this, but this is an internal account. We're looking at how these numbers are arrived at. So we are writing everything in detail, and later on you could club it and make a nice presentable statement. Alright, the impact is on the balance sheet under non-current assets as well, and same goes for the depreciation on furniture as well. Alright, so now we have done the second step, which is making adjustments for the additional information. All we need to do now is to figure out the amounts of gross profit, net profit, and then total the balance sheet. So let me just figure out, quickly do the totals, and I've done those already. The total comes out to be 200,000 on this side. Again, the convention of the accounts, closing the accounts is being followed. You have gross profit here, 2 gross profit, and this is carried down. This of course is a balancing figure as well. So 60,089 and 75, you're left with a gross profit of 43,000. Now you bring this forward by gross profit brought down 43,000 on the credit side. This gives you a total of 46,000, and this leads to a net profit. So to net profit carried down, this is a balancing figure of course, of 24,450. This is the balancing figure, and this is going to be added to the reserve and surpluses in the balance sheet. So we go here and we say reserves and surplus, and you have 24,450 here, right? And in the balance sheet, there were no non-current liabilities, surprisingly. Non-current liabilities, but we'll just keep it for the sake of format. You sum these up and you have a total of 143,450. This is the total of balance sheet on both the sides. So there you go. In this video, we looked at the adjustments to be made. We did a discussion on how these adjustments are to be made and where all will these be impacted. Now you know the whole process of preparing the final accounts plus doing the additional adjustments according to the double entry system.